Okay, there we are. So thank you, David, Paul, Best. We are in our 15th presentation of this two-day event, and we are just about to bring Yanis in for our options seminar, something we haven't talked about much at all over the last couple of days. Options trader. Is there anybody here that is an options trader, first of all, or has any experience? I'm just going to bring Yanis into the webinar. For those of you that have dogs, you'll understand what happens when they see a cat outside the window.
Hello, Simon.
Yanis, good afternoon.
How are you?
I'm fine. Well, we're both doing the blue shirts today.
Yeah, you see?
We're matching.
Great minds think alike, my
Five.
friend.
Yeah, I'm sorry about the dog. He sat quietly under the desk all day, and then as soon as we do that, he sees a cat and just goes crazy. It's good to hear, Yanis. We've known each other for many years. We've just sort of reconnected this year, which is great. You're coming over to the show at the end of April in London, and the reason you're here is because you're a specialist in trading options, an options strategist. What we don't have on this event, as I was just saying, is anybody that talks about using these derivatives products. Options trading, I know it used to be before CFDs in the UK and spread betting, maybe some more options trading, but it's still very relevant in this market. It's still a very useful tool, not just for hedging, but also just for looking at strategies for making profits. And I guess that's one of the reasons I asked you here today was because you have a strategy which has the probability to win more times than it loses, and it would be good. Often people get confused, solve it too complicated, but you're here to try and say, look, it doesn't have to be complicated. It can be simple. So
Yes.
that's what we're pleased to have you here. So welcome.
Well, thank you very much, Simon. You don't need to be a math whiz, yeah. Unfortunately, my English is not up to the level of your previous speakers, but we'll try to do something. And,
your English is fantastic. It's better than most of them, actually.
Thank you very much.
Why we get started, I'm just posting these two links, like we said, just so people can have a browse
Yes.
your website, and that's your YouTube channel, because there's lots and lots of content there. But yeah, so how do you want to do this today?
Well, I'm just, I will start sharing my screen for 1 minute for people to get to know me a little bit better. And then I'll put on my presentation. It will be, I'll do a little bit of magic to finish off within 45 minutes and then allow 10, 15 minutes for people to have any questions if they want to. So I'll do this quickly. So
the dog is now gone, so he won't interrupt us again. I'm happy to say. Fantastic. I just said that I just asked people at the beginning to see if anybody is trading options. Paul says no. Milo says yes.
Okay.
So Connor, if the dog comes back, I'll hold him up. Monty might be back soon. So that's fantastic. YouTube channel is all Greek.
Yeah, but not all Greek, basically Spanish as well. But yes, the YouTube channels is, there are actually a few panel moderations from the London, what's it called, the show, the IFX show. But truth be told, yeah, there's a little material in English. But anyway, I just wanted you to take a look of who I am. But you will see a little bit more about it. And hopefully at the end, you would like to join me in my next seminar in English, as well as see me live within that IXO event on the 28th. So I will kickstart, Simon.
Please, I'll turn my camera off.
Okay, then, yeah. So presentation today is not about showing you slides. I'm just going to use traditional flip chart here and take your time for about 45 minutes. Before I do that, I'd like to show you who I am. Well, I guess you can see the slide, right? Simon, if you can just drop a...
Yes, we can.
Yes. Okay, so who am I? Well, I've been 25 years in the markets. Yeah, 9 of those in London. I've been working for CMC Markets, bringing CFDs for Latin America and mainly Southern Europe. And then I jumped in Citi. So I was working for the trading floor at Citi, doing structured products on FX options, so clients of hedge funds and everything. So spending 9 years in Great London and then moved back to Greece and traveling the world. Ever since, I've done a master's degree in Birmingham and another one in Madrid, which is why I speak Spanish as well, fluent. I do speak 5 languages fluently, so that allows me to travel the world and meet different people, however, with the same psychological biases on the basis of which is the seminar itself. Myself as an international speaker is because I frequent events from Dubai to Mexico to London and Cyprus, talking about options and moderating panels. I also have a magazine, it's also in Spanish. We used to do it in English about 11 years ago, and hopefully will come back again at some point, but it's Traders Magazine, and I'm partner and editor-in-chief on that. And on the basis of that, well, I have 3 kids, and I love my music. I used to play, and I still play the piano for about 35 years. By the end of this, there is some information on the seminar that I offered if you guys like it, but my phone number is here, WhatsApp is easier for you to use, and my website, which is also what Simon shared. So let's kickstart. Now, options, I'm not sure the level of everybody, yeah, but I think the misperception of the majority of people is that they think options are very difficult. You need to be a math whiz, you need to know nuclear physics, and this is not for me, etc. So I'm here to break all these biases and let you know why you can trade and why it is always superior to trading just whatever you do, like scalping or swing trading, position management, so position trading, whether you trade foreign exchange, crypto, stocks, equities, indices, whatever, right? So options are for everything. And I will start with something that makes options very popular. And this is what we call, and excuse my handwriting, but I'm sure that we will understand each other. So options are called wasting assets. I always prefer to just use the flip chart and try to make it as interactive as possible. But these very characteristic of them losing value as time goes by is what makes it really so important. That and the volatility part of it. And we've seen quite a lot of volatility lately. But let me show you here. So in this chart, what I will draw is a very important aspect of options. So let's find out why it's so imperative to use them. This is the price of the option, yeah? And this is time to expiration. So without the nitty-gritty of the jargon and going into more detail on the terminology we use, options have a specific expiration date. So they expired typically on the 3rd Friday of each month. So because they have an expiration, the time going by actually affects the pricing. And the problem here, as I'm going to show, is that as time goes by, like the song goes, these things lose value. And if they lose value, if you are holding them, it's bad for you, it's your enemy. But if you've sold options, it's very good for you, right? So we're gonna see 3 different strategies here, and we're gonna see why options can be combined with any time of portfolio. So say this is day 0, this is 120, 90, 60, and 30, right? So when the option starts, there's not all type of options, yeah? And I will explain what it is. But options basically is a contract which is with leverage embedded, yeah? So it's not like futures, you don't need extra money, etc. You have different payoff profiles. But for the sake of the argument, you can trade options with any type of broker who offers. This facility is not they're not margined mark to market, so it's not like futures, but obviously, you can see your P&L every single second. They have an expiration date, which is the third Friday of every month, and they have different combinations for an option that bets on the upside and an option that bets on the downside. The one that bets on the upside is called call option, and the other one is called put option, right? I'm not sure why they picked up so funny names, but that's, that's what it is. And the combination between the time and volatility and the type of option gives you what we call option strategies. We will see 3 today, and I think there is ample room to explain them in a simple way. Starting with like an options live. So when an option starts, so we are March today, and we have an option with an expiration of 4 months ahead, right? Which is what? So 4 months ahead, and the option loses that sort of value. Yeah, not much. So starting from here and going here, within 4 months, from now in 4 months, the option value will not lose a lot. So another 3 or 30 days go by, and that thing, if I had drawn it properly, will cost you a bit more than double. So it hasn't started to go progressively, not like a very steep decline, but you can feel the difference. So the expiration is still the same, 4 months ahead. So we are in March, so we are choosing an option that will expire on the third Friday of July. In between, option trades like crazy, goes up and down, right? And it has certain characteristics. So say we buy an option, whether put option or call option, betting on the upside or downside. But if we are now in May, it means there have been 60 days that have gone by. And my option, bar anything else, so anything else, the market hasn't moved, the volatility hasn't gone up, nothing at all, only the days have passed. And the option has lost a little bit more value than it was at the beginning. When we go to 60 days, you can see that from here to here, things start to get nasty. So if you had an option that you paid for $1, now this option costs less than 50. Yeah, because that has started to get ugly. The problem starts here when you have 30 days. So come end or mid-June, and you only have 30 days left to these options live. So while you bet on something, you can see that this curve has started to fall, and it has started to fall aggressively at a very big rate, which means that your option now has lost more than 65% of its value, and the real party starts within that last segment where things really get bad. So you have an enemy. The option will actually lose value and tend to go towards zero while you hold it. So you might end up being correct in your prediction, but lose money because the option has lost money. So why am I trying to say here? While options are wasting assets that are very bad for someone to hold them, it's very good for someone to sell them, right? So we act here like the insurer. You actually bet that 99% of the people who will buy the insurance will lose their money, because that's how human psychology is. And you, the guy who sells insurance to them, you stand to make 99 out of 100 times money, right? Which is what we want to do here as well. Of course, markets have a life of their own, etc. But we really want to act like the insurance, like the casino, if I may. And that's why I do that, because we're not a casino. It's not about gambling we're doing here, but the casino is not trading directionally, right? They don't care if something goes up or down. They just care for you to go there and stay there, because they do make 5.27% every million played. So they don't care about you losing or making money. They care about many people staying there. So for every million, they know for sure they will make X amount of money. I'm talking about the American roulette, because they've got the 2 zeros and 1 0. That's pretty much here. We're trying to get the positive edge, right? The positive mathematical expectation, because when we try to predict the market, we are falling into the same problem as everybody. We are trying to predict the unpredictable, especially lately with power and all these things, black swans around us, right? So instead of trying to predict and falling within these 90-90-90 rule that I typically say, which is 90% of the people who actually trade newbies or a little bit more advanced will lose 90% of their money in just 90 days. And why do they do that? Because they go with technical analysis, with a little bit fundamental, and RSI, and MACD, and everything. So why does it make it different from everybody else, the millions of traders? Nothing. You just stand and think you're better than the other guys, and think that technical analysis and levels you can tell better than they can, right? Which is perfectly okay if you can do it. And options are here to tell you, hey, I don't want to try to see where something is going. I'm trying to predict where something is not going. And this is entirely different. Why? Because if I say that Apple is not going to go above 150, it means that if it stays at 150, I make money. If it falls a little bit, I make money. And if it falls a lot, I make money. And even if it rises a little bit about 150, I make money. Yeah, I stand to make money 4 out of 5 cases without having to predict where the market is going. Let me just try to explain that. But before I go on the wrong fallacy that people have about options, a little bit of an example to understand why they're so powerful. Like, so you remember the Euro 2004 that Greece was playing against Portugal? So I hope we don't have any Portuguese guy together with us today. But we played the first match against Portugal. And now Greece, an unknown country from southern Mediterranean, was playing against, a very big team. And the bookies were giving 1 to 240 odds, right? So $1 will get you $240 if Greece were to win the championship, right? So that is an outcome that really pays a lot. It costs a little bit, just nothing, yeah, but it has very small probabilities of making money. So small probabilities of making money, small cost, but very big payout, obviously because you will have done the impossible. Fast forward 2 weeks, and then Greece has won pretty much every game, and at the last game, we play against Portugal again. Against Portugal, the bookie now, at the last game, is giving 1 to 1.4 for Greece to win the championship. That means $1 now can only get you $1.40, whereas before it was getting $240. That means that now there is a huge probability of Greece winning the championship, so that will cost a lot, yeah, but it will pay out a little bit. Yeah, why? Because it's a sure bet. So a sure bet will cost a lot and we pay a little bit. This, in options terminology, is called an in-the-money option. So a big probability, yeah, for something to happen. It costs a lot, but it pays out very little. And the other one is called out-of-the-money option. So very low probability of making money, and it costs nothing, but if you do make money, it's like hitting the jackpot. Yeah, so they will pay you a lot. That's the difference between out of the money and in the money, what we call for options. So we're basically doing here a calculation of probabilities, and that's why we want the market not against us, with us. So we're not betting with directionality, because that will make no difference with everybody else. We want to bet something that will allow us to make money, even if we are wrong. And we are occasionally are, right? So let me show you what people think options are, and then go into these 3 strategies. So say we take the example of Apple, right? Our beloved Apple. So we have Apple stock and we have Apple call option. Remember, a call option is something that we buy where we want something to go up, right? So for now, we know that option has to do about probability and volatility and magnitude of movement. Yeah, so we, a seminar will actually teach you how these are combined and intertwined. But obviously, wasting assets means, first and foremost, they lose value. So I can't really be there to buy. What I typically say, and what we were saying at the City Trading Room, fantastic experience, 930 places in Canary Wharf, 2nd floor, and everybody shouting like crazy. And then the AT team, the automated trading hedging system in the middle of that room will tell you, Giannis, when you buy something, you have to sell something. So don't be like the guys who actually want insurance now, and then they think, oh, markets will go up, I don't need insurance, and then I start again. You don't have your house insured for like September and don't leave it uninsured for 2 or 3 months, and then go back and insure it again in January, right? Not even your car. Okay, why do you do it with your portfolio? So when you buy something, you have to sell something. That means that you combine positions that will actually make you recession-proof for your portfolio, if you like. So you aim at making a bit of money every day instead of hitting the jackpot one in the 1,000 years. That's the point of using options the way I teach them, at least. So we sell volatility in other ways, and we hedge ourselves. And the other mantra that you actually need, and I do it every day, is when you buy something, you have to lower your cost. So we say pay nothing for something. With options, you can create strategies that can actually protect your portfolio under circumstances and pay nothing. It's zero. So you buy a zero hedging, a zero protection, and then you are protected to an extent for your position. So every time you try to use option, you have to minimize your costs and find ways that the risk-reward ratio is there for you to make money, but still be as protected as possible. Yeah. So you've got 100 shares of Apple, yeah, which nowadays will set you back about $16,000, correct? Because it trades at 160. And if Apple goes up by 10%, yeah, so you stand to make 16 from 160 to 176, yeah? So you make $16. You multiply by 100 shares, so you stand to make $1,600, which is great. But you have to calculate here what your ROI has been, your return on investment. So your investment is $16,000, so you made 10% on your money, correct? Great. On the other side, the other guy who jumps on the internet, knows a little bit of options, has read a couple of books and thinks he can actually go there and dominate the markets, will say, no, why would I spend $16,000 whereas I can buy a call option? Yeah, so first mistake, he buys. So he's got time against him. 87% of the times, these will lose money. Why? I'll show you, because markets are mean reverting. But before jumping there, a call option is equal also to 100 shares. That's how they build them. Yeah? So a call option is like you have the right to buy or sell 100 shares. It's not 90, it's not 110. It's 100 shares. So if I buy a call option, it's like buying 100 shares. But this call option will actually, depending whether you buy it in the money, out of the money, with big or lower probabilities, say it will cost you $3. Yeah, it's not $3, it's actually $300. Why? Because one option is equal to 100 shares, right? Apple has gone up. Now, obviously, this has a expiration, say, the third Friday of next month, which is 21st of April. Yeah, so it has an expiration. So that means that this will actually have an effect on that. So I pay $300. Apple goes up within that time frame, hopefully, and I make $16 myself. At the end, nothing else applies in terms of volatility, time, or anything. It's just where the market has ended and where you have bought, which, by the way, we call it exercise price. Where would I like to exercise? So say my exercise price was also 160. Yeah, it was 160, the price of Apple. So I buy this call option, 160, I think is going up. Apple goes up 10%, makes $16. I actually multiply by 100 because one option is 100 shares, and I have made also $1,600. What's the difference here? Well, I deposited $300 and I made $1,600. My return on investment here is a bit less than 6 times. Yeah? Obviously, this is an example. It might be 5 times or 100%, but you can see why people prefer to trade options. But they do it wrongly. Why? Because they buy and this thing is against them. They don't have a strategy and they just think, oh, Apple is going up. Well, it's the same thing. Yeah, he's betting on the upside, right? So there's no difference than somebody who's doing tactical analysis betting on the upside. And it's actually worse. You're doing it with leverage. This has leverage embedded. What's the problem here? 87% of the times you're going to lose this money. Why? Because time is against you. It's very difficult to get the timing right, which is always the case. Yeah? Why? Well, let's talk a little bit about statistics. In a bell-shaped distribution, so the normal distribution taught to us and perfected by Gauss, you have two important metrics. One is the Greek letter M, the median, the arithmetic medium, yeah? And the other is the standard deviation, correct? So for those of you not statistically savvy, all it means, one standard deviation here, that's one standard deviation, deviate from the mean, it means that 68% of the times I expect the market to move, to go down or to go up. This is drawn like giving you the same probability for the market to go down or the market to go up, which is not the case. The market never has the same probability and people never bet and hedge the same way. They always need to hedge because you don't fear that markets will go up. You always have a fear that markets will go down. So you will always want to push the prices of your protection up, which is very good for us because we have learned how to sell this to you. And as the insurance goes, the insurance game, you stand to lose 9 out of 10 times. So I'm playing on your fear, but also on something which is called reversion to the mean. So this is the mean on a bell-shaped distribution, a normal distribution, and one standard deviation means 68% of the times. Two standard deviations here is 95% of the time, so 95% confidence is that prices will move either from here to here or from here to here. Yeah, if you take a sample, for example, in a university, to put it bluntly, the average height of a person is about 178. So 178 will be here. And one standard deviation will be what? It will tell you that 68% of the students will be about from 160 height in centimeters, yeah, to 191. And if you go two standard deviations, it will mean that 95% of your students will be from 150 to 2.03. And if I go three standard deviations, which represent 99% of the sample, then we either have dwarfs or giants in the classroom, correct? That's what it means. But when it comes to investing, it means that how big is the probability that Apple goes to 100 or 200? We probably fall into the three standard deviations. So because it's almost certain within X amount of months Apple to move that big, then the payout will be nothing and it's not going to be any worth for you taking it. But if you say, yeah, Apple has 68% probabilities of staying between 132 and 162, it is quite probable because that's the movement of Apple within the, well actually as of 4 months ago, yeah? So why is it important? Because financial assets tend to revert to their mean. Microsoft, because of the chat GDPI, has gone from 229 to 278, back to 249, 270 again, back to 60, and 2 months ago was around 230, right? Apple was in between 130, 150 for the better part of 2023. And I can think of 1,000 more stocks that have done the same. Unless a stock like Tesla, or favorite Tesla, which fell from 200 to 110, gone back to 200 again within a matter of 2 months. Yeah, you don't need to trade options with that. Of course, options will actually tell you, hey, something's going on here. The market is getting very excited about call options on Tesla. But these are the nitty-gritty stuff that you can find out, study. Or the volatility issues that options provide that actually tell you when a crash is imminent. The stuff that it predicted for the 2020 COVID crash, the stuff that it predicted together with the inversion of the yield curve of the term structure of interest rates, things like that. It's not about trading, it's about reading between the lines, but you have to know the theory, right? So what would an Apple stock do? Well, it goes from here, goes down, goes up, wave down, wave up, a little bit down, and what does it do? Well, it actually has moved around that line, which is the mean. So that's why we try to sell volatility and actually tell that Apple will not go above here or below that and will tend to revert to its mean. That means that it will be losing value because time goes by And even if it goes away a little bit, it comes back. And that's what financial assets do. So we are here to take advantage of that by doing strategies that can say, if Apple goes up, I make money. If Apple stays, I go money. If it loses a little bit, I make money. I'm sorry. The only way I can lose money is in either extremes, yeah, depending on the strategy. But for now, we understand. I haven't used a MACD indicator, an RSI, or an MA. It's perfect. I use technical analysis to about 20% of my analysis. But the power of options and the statistics they can give you without needing to read about 50 books, yeah, is awesome. So let me tell you what the strategies are by starting from the simplest, yeah, and this is called a cover call, yeah? So again, you don't need to get too worried about how this is structured and everything. These are things that I explain in my seminar, or you find somebody else in the market. Obviously, you can have a mentor, etc. I'll show you what I teach in my seminar at the end if you're interested. But what it is actually, I'll show you why it is always better to use options with your stocks. I didn't say get rid of your stocks or get rid of the long term. But in the short term, such statistical nuances like, the noise that we call it, market going up and down. Powell raised rates by 25 basis points yesterday. Everybody was saying, yeah, that's what you will do. The markets went down 160. Today, markets went up 0.80. There is no logic behind whatsoever. And apart from that, the last month and a half, markets have been oscillating around the 4,000 mark of S&P. So if you were holding an ETF, nothing would have changed. In the meantime, I can definitely guarantee there have been a lot of traders going bankrupt with these ups and downs, unless you are a fantastic scalper and maybe you had your great 1 month of your life. And yes, there have been people making money. Most of the people losing money if they try to time the ups and downs, because there wasn't any real clear sign of how to deal with things. But hey, let's say you want to buy Apple, yeah? Apple, you draw it like that when you buy a share. This is a long future, this is a long stock. So I buy Apple and you guys buy Apple. So we bought 100 shares of Apple, yeah? So what I'm here to tell you is I also sell a call option, strike price 175, let's say that, yeah? So that's how we draw it. It doesn't matter, you learn these things. The important thing is to understand the power of options. So when I sell a call option, what it is that I want the market, in this case Apple, to stay below that strike price that I chose. Yeah. So every time Apple stays or finishes below 175 towards the end of its life, yeah, towards the end of expiration, I stand to make the $2, which is the premium I got. I didn't pay. I put it in my pocket. So somebody paid me to protect my position. Yeah, I get paid. I like to get paid. That's not $2. It's $2 as referring to the stock price. It's actually $200 that go into my pocket because you multiply always by 100. Now, that means actually that for me, Apple, I bought it at $158. So I'm always better by $2 than you, and I will explain now. So say Apple does go up and goes to $170 within that time frame until the 21st of April. Great. You make $10 from your stock position, correct? You don't have call option. I have that, yeah? So you make $10 and that's it. I make $10 of my stock position, but I make the $2 from my call option that I sold, the call option that I sold, because it finished below the 175 strike, right? So one scenario is where I make more money than you with the same thing. Apple goes to 175, goes a little bit higher and touches my strike price. You stand to make $15 from the stock. I stand to make $15 from the stock, but I also make the $2 from the option because it has expired worthless. Why? Because the price has not gone above the strike price that I chose. Two scenarios that made more money than you from you. Apple doesn't do anything. Stays on 160, goes up and down at the end of the options life. Within a month, Apple hasn't done anything. You haven't paid anything, great. You haven't made any money. I haven't made any money, but I got $2 for my option. Third scenario, better than you. Apple falls to 158. You lose $10. I lose $2. So you lose 2. I lose 2. But I make 2 from my option. So I lose nothing here. It's 0 from me. The only time where you stand to make more money than me is the only time 1 maybe out of 10 that Apple or any Apple will do that. It will go up for whatever reason and stay up, yeah? Because like I said, Microsoft was going up for a week, but then retraced for about $30. Is when market goes up very quickly. So what I do? Well, here, you stand to make money, but I stand to lose money from this point onwards. What is it called? Well, I'm not losing. Why? Because you're making money from 160, say it's going to 200, yeah? And stays there. They don't do these things, yeah? And you don't choose stocks that do these things. But say Apple has done it, 160 to 200, you made $40. I made from 160 to 175, I made $15, yeah? Plus the 2. To 177, I'm still making money from the stock, but I lost all my premium. I gave it back. Not a problem. I put it in my pocket, now I gave it back. So I made $17 from my stock, and then I make nothing more. You make, but I don't make. But I don't lose. You know what this is called? This is called cost, opportunity, cost of capital. It's not called loss. It's just you make more money than I do. But how many times will you make that? 1 out, I don't know how many. In the meantime, all the other times, perhaps 9 out of 10, I stand to make more money than you. So that's why I want to be in this probabilistic game. And this is a simple way of covering an existing stock position. Fantastic for those of you holding long term. Yeah. But you can see the privilege here. The scenario is 4 out of 5 is that I make more money than you guys. You haven't used the call option. Yeah. So for every 100 share, you use 1 call option. So this is hedging, obviously, but it's free money for you, as I said, because markets tend to revert around their mean. Another one, and Warren Buffett used that, is what we call a short put. Now, this is a naked position, and for those of you with a little bit of experience in options know that naked positions are actually, dangerous, because if something goes bad, this obliges you to buy the stock, but you will always be obliged to buy the stock at a higher level than when it trades now. So we use the example of short put, but this can also be what we call a cash secured put. What does it mean? That, the stock might fall, but I have the money to buy it. I had an Alibaba position with a strike price of 85. Alibaba finished 80 on that day. I was made to buy my stocks at 85 while the stock was trading at 80. Within 2 days, Alibaba is trading at 87. Yeah, so I didn't lose money, but I had a stock position. So you don't lose money when you have the money to support the position. But say we don't have the money, and Apple trades at 160, but honestly, I don't like it at 160. I don't know, but I like it more at 130, which is where the mean of the last 6 months is. So what do? I just say, hey, I choose the strike price of $130, and the short put option will look like that. I sell an option again. What does it mean? I make money. They pay me again. Why do they pay me? So say they pay me the standard $2. So they pay me $2 on my stock to do what? Well, if Apple is here and I sell this option, I'm obliged to buy Apple at 130 if it falls below that level, which is our break even. Anything above 130, I make 100% of my premium. How typical or easy is for Apple to lose $30 within my 40-day window until expiration? Very difficult, I will tell you, unless something happens with Putin, another black swan or anything like that. So if you were to choose, I don't know, Teladoc or Netflix, yeah, it might be easy, but you don't do options on this. You don't need to go on these type of stocks. Instead, you can trade, it depends on different factors, but you don't need to go in high beta, high volatility stocks. So what it is here, your scenarios, if Apple goes up, you make all the money. Why? Because it's still higher than $130. And if Apple stays at 160, you make all the money because it's still above 130. And if Apple falls to 140, you still make all the money despite Apple having fallen by 10%. So Apple goes up, I make money. Apple stays the same, I make money. Apple falls by 10%, I make money. It's ridiculous, seriously. Where do I lose? When Apple falls and does a very big move and say finishes at 121, what does it mean? I'm obliged, it's not a right now, it's an obligation to buy Apple shares at 130 while they're trading at 121. Not a problem. If I have the money as a cash secured put, I buy the Apple shares, and then what do I do? I go back to the previous page and start selling calls again. Why? Because Apple will actually absorb these low levels, stay for maybe a couple of weeks or even a couple of months, and then starting its way up again. While you're waiting these couple of weeks or months, you stand to make more premiums on the call options. And when market actually shows that Apple goes up, you close the call options at some point, and Apple actually goes back to 160. And you've made money from all the times. Every time that Apple didn't touch the 130, God knows how many $2 you got, and you make money from the call options you sold, and you make money from the shares that have eventually gone back up again. Why? Because financial assets are mean reverting assets, unless we are in a COVID situation, for example. You have situations like that, but COVID doesn't come all too often in our lives, right? Even with the war, there have been movements up and down, but these strategies were actually working the same. Yeah? Good. If you want it on the other side, just to complement, this actually allows you to buy shares at the price that you wanted. Why did I mention Buffett? Because Buffett will say, I want Coca-Cola here and not here. He will be selling thousands and thousands of options to take billions of premium, and at some point, Coca-Cola will fall. He doesn't matter. He buys Coca-Cola for like 2 lives. Yeah? So it's like buying or setting a limit order to buy here, limit order to buy, except if you don't use options, except while Apple is above your strike price, a limit order will not pay you anything. Options will pay me for months and months until I wait. So while I wait. So I'm getting paid while I wait. Yeah. And let's talk about the last one. Well, you've got about 56 combinations, but at a 40-minute talk, there's only a few things that one can say, but I just want to give you the infinite examples that you can get, the infinite, opportunities that you can get with options, right? So the 56 combinations, you can play with time, with volatility, much like a football game. You can tell like Real Madrid will beat Barcelona by 2-0. Yeah, but you can actually bet that the first goal will be scored within the first quarter. And then somebody will score it with a free kick. And the second one will be a penalty. The more options, the more alternatives, the more things you add in an equation, the more difficult it gets to win, and the bigger the payout will be. That's the same with options. Yeah. So that's the 56 things. You don't have to trade 56 different strategies. I trade 6 or 7 because the important thing is while you make the strategy, how you go out, how you exit the strategy, how you manage your risk when things go bad. Yeah. So let's take a look here. Is a spread. It's a combined situation between 2 types of options. And this time is the put option we're talking about. So a put option typically will protect you against the fall. It's your insurance. Yeah, so much like you pay insurance for your house, you would buy a put option to protect your portfolio. The problem is that we end up again doing the thing that I hate the most, buying. No, I want to sell. So what do? I do a combination. I sell and I buy. When you buy something, you have to sell something. Why? You lower your expectations, you lower your payout, but you also lower your risk and you lower your cost. And this is how you need to think as professional traders, if I may. And even if you don't do trading for a living, the majority of you don't, then it's still the same strategy that you can use whatever your portfolio, whatever the assets you are trading or investing in, and whatever your time frame horizon, because options, you can trade them, the 0 DT, probably you've seen in the news, the 0 days to expiration options. So you trade within a day, this thing goes up like crazy. 100% up, 200% down. It's going like crazy, but it's not the same. And that's the beauty of it. They have different behavior when there are 30 days to expiration, different when they have 5 days to expiration, because there are different factors, which by the way, we call them the 5 Greeks, surprisingly so, that affect, we call them the sensitivity factors, volatility, time, the movement of the underlying, and so on and so forth. But to keep a long story short, what do I want to do? I want to sell a put option, much like I just did before in my previous slide, so to speak. Why? At, say, Apple. Yeah, Apple trades at 160, so I would like to buy Apple at 150. Or I would like to make money whenever or as long as Apple remains or stays above 150. But I don't want to buy Apple in case it falls. And honestly, I'm not sure where Apple is going. So what do? I buy my insurance. I go to 140 or 135 strike, and I buy my put option. Why do I draw these things like that? Well, they're not arbitrarily drawn, they're like that. But you don't need to know for now how they're drawn. But what you get is actually this combined position. This is called a bull put spread. What does it do? It sells volatility, so it bets that something ideally needs to die a slow death, so days go by, but I have also my option which will protect me for steep falls. Yeah. So what does it do? Here we have, if Apple goes up to 170, what does it mean? Here I sold the options, I got my $2. Yeah. And then I bought an option, but I bought an option to protect myself from 135 and below. That option, I mean, Apple being at 160, I buy my insurance for 135 and below. That means that Apple has to fall $25, and then I start to get insured. And I'm talking at the end of the options life, because in between crazy things can happen. But for the sake of the argument, we're talking about end of expiration charts. So it's a big disadvantage, and I'm not going to pay $2 for that. I'm going to pay, for example, 60 cents. So what have I got as a premium at the end? $2 minus 60 cents. I got $140. This is what I need to know. I'm standing to make $140 per every spread that I sold, yeah? Whenever Apple goes up. Because Apple goes up and above 150, I stand to make all of it. If Apple goes down by 10% or by $10, say in this example 8%, I stand to make all of my option premium because it hasn't breached the 150. If Apple stays at 160, I stand to make all of my premium. So it goes up one scenario, I make all my money. Stays the same, I make all my money. Falls by 8%, I stand to make all my money from the premium. So I take the premium at the start, and then it stays in my pocket. Yeah. So where do I lose, Giannis? Yeah. Well, where you lose is actually, this is the break-even point. Yeah. So the break-even point is what? If I got 140 and this is the strike 150, this level is 150 minus 140, which is my premium. So it's 148.60. Below 148.60 and up to 135, I lose money. So I've got a $13 window where I lose money. And that's the bad thing Why? The risk-reward ratio is 1 to 12. I stand to make, or 1 to 13 in this case, I stand to make $1.4, it's actually 112, a little bit less, $1.4, and I stand to lose what? $1,300. Doesn't make any sense, right? The good news is that you stand to make money 87 to 90% of the times with that. Why? Because time value is your friend now, is your ally. Options will lose value, and you get to keep the whole premium, and also financial assets are mean reverting. Even if Apple falls by 10%, the probabilities are 68% of the time for one standard deviation, which is how I pick the strike prices. They are not arbitrarily picked. Yeah? Apple will actually, even if it falls, will go back again. Yeah? Within this short time frame. So 90% of the time, I'm going to make money. The bad news is that one time that I fall, I stand to lose a lot of money, so I don't let it. So what do I do in finishing within the next 5 minutes? Just to give you a thumbs up. Well, my first choice of risk management is to move this strike. So say Apple goes 148, I have to move my strike to the next month. Say May. So what do? I roll down in time. Why does it help me? Because now I've got 30 more days. And 30 more days is a lot of time for Apple to move around a little bit and then hopefully go back again above 148. And I stand to make all my money again. Yeah? But Apple has gone into a very downward spiral. It doesn't work and keeps falling and goes to 145. So now I have to do my second exit strategy. What is that? I have to roll it out in time and down in strike. So I don't use the same strike now. I go to 140 strike. My 135 put options are still making money because Apple is falling. That's my insurance. But I'm losing from the short put. So now I move it down to another strike and down or further away to a month. So I gain more time and I gain more room for maneuver. Yeah? But hey, shit happens, excuse my French. And Apple continues to go down. I mean, sometimes very good stocks, like Alibaba, for example, which I used to trade, tend to go into a very bad phase, and nobody knows why. So, third time, what do? You do what we call a delta hedging. What is delta hedging? Without going into much detail, it means that from this point onwards, whatever this put option loses, I will have another option that will make money exactly the same. So if that option, the short option, continues to lose, I will have a position with another type of option, so more purchased options that stand to make money as of this position. So the more I see Apple going unstable, etc., I can do my delta hedging and protect my portfolio and make it immune to market going up and down. So I stand to make money from the time going by. If you don't want to do a delta hedging because it costs a lot, you pay commissions, you don't know, you're not expert, etc., what do? The stop loss is when that option reaches about 200% loss. It's not a lot, don't get panicked. What does it mean? If I sold that one, it's gone to $3, I have to hedge it. How? The delta hedging. You can stop loss and exit the position. And normally, when market goes like that aggressively within a short time frame and reaches the 200% loss, it will continue to fall. The same happened with Microsoft, but on the other side, going up. The same happened with ETF, biotechnology, because these guys were taking money from SVB, which collapsed. So XBI was falling 10% in one day for no reason. I mean, this is the systematic risk that you cannot control. So when it falls, it continues to fall. Oil does the same. Rates, the TLT, which is the 20-year bond ETF, had, during a year going only south. So when things go bad and they start at 200%, that means the option has gone now in the money. This is bad for you because you've sold it. So this is now your idea to hedge. What does it mean? At the end, you might end up losing a little bit of money You might end up losing, but only a little bit. You're not going to lose 13 times, and you're not going to lose big. Perhaps it gives you 9 out of 10 times that you made money with selling options all these months, and depending on when the bad thing comes, the bad timing, you might stand to lose some percentage of your positions. But when you're doing these things, you're not facing the market as something of a binary choice. Up, I make money. Down, I lose money. You don't need me for that. You can do it yourself and go buy and do the same that 90% of the people do. Instead, if you want to make something out of it today, you can start thinking out of the box and different than what Bloomberg says or CNBC or your friend at the kiosk. You have to start using options no matter what products you use, what strategy you follow, because like I showed here, hopefully, within 3 strategies, you've got a whole new world opening up to you where you stand to make money every week, every expiration, and controlling your risk in the best possible way. There are 56 strategies. Imagine the versatility and the options that they give you to trade, and all you need to do is actually start to learn options in a way that is systematic and very compact and easy to follow. Because if you go on and start reading books and reading blogs and everything, you will learn a little bit, but you won't be able to combine it. It's the same thing with options like technical analysis or fundamental analysis, right? That's why people actually learn more from other people who have chosen this path. And before I go to your questions, if I may, I share my screen and show you a little bit the course outline. So if you're interested in doing options, whether you do it with me or somebody else, but if you do it with me, the course outline to learn about options is talking about diversification of the markets and why inflation has been hitting us hard and what are the similarities, if any, with the 90s, 70s and 80s inflation and the gold standard and all that. The diversification in a portfolio, how you do it, the hedging of a portfolio using your beta, which is the degree of responsiveness to a pull of the market, the correlation coefficients, so a little bit of theory of the capital asset pricing model that you need to actually know to build a well-diversified portfolio that will match your risk criteria and will be actually immune to shocks, whether short-term or medium-term shocks. Learn how to use leverage and margin calculation with futures trading to use your hedging mostly. And then options, as you can see here, I actually talk about risk management, optimizing your risk return, talk about the nitty-gritty of, why do I choose a specific option, how the option chain is read. Yeah, so what are the 5 Greeks and how do I do hedging? We've seen one here with a cover call. There are different situations where you can use with different names like straddles, strangles, collars, iron condors. God knows why they use this terminology, but I can guarantee all you need to learn is 20 new words. These 20 new words is for me and you to help you understand each other without having to use long sentences. And my course is online. And there is one that I actually doing in about 3 weeks' time. It's obviously in English because I do it in different languages. This one is in English, and you get to get your recording. So it's yours for life. And then you go over your recordings once we've done it live. That is, I trade live during my sessions. I trade using the same strategies that I teach you. You can see the results of the, other clients of mine who use the strategies that they've been taught. And of course, then I'm here next to you as a mentorship, if you like, because there are other ideas as well where I generate and I share with my clientele to do this thing, open this position with this strike, this premium, etc. But also, most importantly, when to exit, how to hedge a losing position, and why. Right? So you can have the seminar, and then there is also the mentorship that continues. And obviously, I'm available for you guys. Happy to meet in person if you come around at Simon's show on the 28th of April. And I think, you got from the previous slide here my phone number, which you can use on WhatsApp for more information. My website is in 3 languages. One of one of those is English. So you can find out a bit more about me actually from my YouTube channel, which is here. But then again, like a friend said, most of the information is Spanish and Greek. However, there are a couple of panel moderations that I've done, but you get an idea of testimonials from other people, etc. So let me stop sharing the screen and go back to your questions, if I can find where the screen sharing is.
Yeah, superb. What a great presentation. Really, really good.
Well, thank you, Simon.
Can you see the chat box there? But I mean, the huge amount of questions. But Dan is asking about brokers. Do you have a favoured, or is there good options brokers for UK-based investors?
Yeah. Okay. So the answer is yes. Yeah, I found it. Let me start. Okay, so different things. The broker that people typically use is interactive brokers. You have London branch, etc. I used to trade with TradeStation. You can use Thinkorswim from Tom Sosnoff, etc. I use another Cypriot broker for smaller portfolios because people don't pay the data fees with that, and if you got a little bit of money and not like in the hundreds of thousands, then the Cypriot market might be better for you. It's still Cyprus, it still covers 100,000 by the equivalent FSCS scheme. So then, because IB will ask you a long questionnaire, you have to qualify. It's incredibly difficult to get through a person to talk to. If there is any problem, you better pray God that they will answer you in 5 days, whereas in Cyprus, it's me you're facing if you want. They speak English perfectly, so you get your job done within a minute. How long is the course? The course is, Steve, 14 hours. So it's arranged over 5 days, 5 evenings. So about 2.5, 3 hours each session. And we do it via Zoom. I sent you the recordings. We do live trading and I cover all the sessions that I sent there. And then you take it home for you forever. And then I'm here to solve any questions, to answer any questions. I'm sorry. A newbie to options will take not a long time to pick this up, Paul, but the best way is go through the seminar and then open an account, put whatever money you want, $2,000, $3,000, it doesn't matter. But don't try to make money from the first year. Try to learn. So the first year is for you to understand, okay, Giannis, you taught me how the theory is and practical and everything, but really what it is about, and yes, it is a Birmingham certificate from my master's. Yeah, thank you very much for recognizing. It is really 1 year. You see the ups and downs, you see the options chain, why an option moves in the way, and then you remember, oh, Giannis told me on the 3rd session, the 4th hour, that evening, let me go back and check. Oh yeah, theory actually follows practice. And then you can see how everything flows. So you don't need a lot of money, just a little bit of money to actually find out how they evolve in practice. So you need live data for that. And if you come to, a Cypriot broker like the one I use, it's a multi-trading platform. So you've got options, you've got stocks, you've got bonds, you've got futures, you've got pretty much everything, right? So you can trade your English stocks if you like. And it's really good. So it depends whether you want to study maybe half an hour a day or 3 hours a day. But the idea here is not to enslave yourself more. I don't want you to put yet another screen in front of you guys. I don't want you to spend another 4 hours. I can have tons of books that I can recommend if you want to do the seminar or not do the seminar, but tons of books for you to read. But as I say, reading a book doesn't make you an expert, and you have to connect the dots. That's the problem in everything. There are millions of books talking about technical analysis, how to make money in the stock market, yet 90% of the people will lose 90% of the money in 90 days. There is a reason for that, yeah? What other questions? Well, I don't see more questions here. Maybe we can stay a little bit, a minute or two longer if you guys like, but I think I stayed within the 1 hour guidelines.
You did really well. Dan was asking about Traders Magazine. He said he's got a lot of copies of the old magazine when it was in English.
Yeah.
Is there any way of getting them in digital form online again?
Not anytime soon, my friend. We wanted to do the English version again back in conjunction with another partnership, but we're not sure if it happens. But I still run the Spanish version. A friend runs the Italian version, and Lothar, my partner, runs the German version. But yeah, we don't have an English version as we speak.
Fantastic. Okay, I think we've just about covered all these.
Yeah.
Thanks, everybody. Thank you, Yannis. Another great, I mean, my hero during the crisis, another Yannis Varoufakis, your finance Greek.
Varoufakis.
Varoufakis,
yeah.
big part. Yeah, I mean, what a hero.
Yannis with one N.
He was a real hero, and I've read his books as well. Chats with My Daughter, and all these great books, and he just manages to dispel all this economic news. He manages.
Yeah, it's a very controversial personality here in Greece, but yeah,
Yeah.
you either love him or hate him. There is no ignoring him.
I imagine. Well, I think I'm on the love him. I quite like his style. He's a big motorbike.
Thank you very much, Steve. Yeah.
Well, thank you, Jack, for joining us. And we'll catch up again soon. Of course, you're in London actually physically next month.
I am.
Myself at the IX show, Friday the 28th of April. You haven't got a ticket, just use that button at the bottom here, and you can book yourself a free ticket. We're going to be at Covent Garden. It's just between Covent Garden and Holborn. So it's Friday the 28th of April. So look forward to that.
Yeah. Okay. So anybody who's interested in the seminar, etc., just pop the question, WhatsApp, website. Before we meet in person, hopefully on the 28th of April, I will be hosting this seminar, the paid seminar. So if you want more information, feel free to ask. And hopefully it was easy to follow. What can I say?
Very good. Love the flip chart. Love it.
Okay.
Yeah. That's a nice break. We like PowerPoint as well, but honestly, what a lovely break. So
if you get over your 50s, you can't get over your flip chart. You need your flip chart.
Take care. We're going to see if our last speaker is available. Yannis, thank you again.
Thank you very much. Take care.